Welcome to Factful Finance, where we bring you the insights you need to make smart financial decisions. Today, we're diving into something that's crucial for anyone stepping into adulthood: credit and debt, and why high schoolers need to get it right from the start. So let me ask you a question. Have you ever wondered why so many people end up buried under credit card debt by their 30s? It's not just bad luck. It's because they didn't understand the power of credit in their teen years. The truth is, the financial decisions you make today will follow you long into the future. And that's why it's vital to learn about credit and debt now, while you still have time to avoid costly mistakes. Before we go further, a quick disclaimer. The information in this video is for educational purposes only. If you need personalized advice, consult a financial professional. All right, now let's get into it. When you're in high school, you're probably thinking about a lot of things: grades, friendships, and maybe even that first car. But one thing you must start thinking about is credit. Building it, understanding it, and managing it responsibly will have a huge impact on your financial future. Let's break this down. 1. What is credit? Credit is essentially the ability to borrow money with the promise that you'll pay it back later. This can be through credit cards, loans, or even buying things on a payment plan. But here's the catch. Credit comes with responsibility. If you manage it poorly, it can lead to huge financial problems. Let's take a look at Liam, for example. When Liam turned 18, he got his first credit card. He thought it would be just like using a debit card, but he quickly racked up a balance. By the time he was 20, Liam found himself struggling with high interest rates and minimum payments that barely made a dent in his debt. Fast forward to today, and he's still paying off that credit card debt. His credit score? It's in the low 600s, and that's going to make it harder for him to qualify for a mortgage or a car loan when he's older. 2. What's a credit score and why does it matter? Your credit score is like your financial report card. It tells lenders how likely you are to pay back borrowed money. The score ranges from 300 to 850, with 700 and above being considered good. The higher your score, the better interest rates and loan terms you'll get. A low score can make it harder to get approved for things like a car loan, and you might even pay more for insurance. Take Olivia, for example. She started building credit early by getting a secured credit card where she deposited a small amount of money up front as collateral. By using it for small purchases and paying it off every month, Olivia was able to build her score to 750 by the time she graduated high school. This meant she got better loan terms when she went to college and saved money on interest. Step 3. How do you build credit responsibly? First things first, you've got to pay your bills on time. Missing payments can knock your credit score down and stay on your record for years. If you don't have a credit card yet, you can ask your parents or guardians about becoming an authorized user on their credit card. This means you'll be able to build your credit history while they take on the responsibility of the payments. Next, keep your credit utilization rate low. This means not maxing out your credit card, even if you can afford to pay it off. Aim to use less than 30% of your available credit. So, if your credit limit is $1,000, try not to spend more than $300. Finally, don't rush into taking on lots of debt. Just because you can get a credit card or loan doesn't mean you should. Start slow and only borrow what you can afford to pay back in full. Step 4. Avoiding costly mistakes. It's easy to make mistakes with credit. The biggest one? Racking up debt without realizing how quickly it can spiral out of control. High interest rates on credit cards can make small purchases turn into big problems. Let's look at Benjamin, who bought a new gaming system for $500 with his credit card. He thought he could pay it off in a few months, but when interest added up, that $500 purchase turned into $800. Now he's stuck with debt he can't pay off as quickly as he thought. Another mistake is ignoring your credit score. It's easy to forget about it until you need it, like when you're applying for a car loan or student loan. But keeping an eye on your credit score early on gives you time to fix mistakes before they become expensive problems. 5. Student loans. Know what you're signing up for. If you plan to take out student loans, know that they can stick with you for years after you graduate. Federal student loans usually have lower interest rates than private loans, but you'll still need to budget to pay them back once you start earning. If you have to borrow money, only borrow what you absolutely need. And remember, the more you borrow, the longer you'll be paying it off. Tools and resources. To help you get started on the right foot, there are several apps and tools you can use. Mint is a great budgeting app that helps you track your spending and savings goals. Credit Karma offers free credit score monitoring so you can keep an eye on how your credit is doing. And Student Loan Hero helps you plan and manage your student loans. As we wrap up, remember this. Credit is a powerful tool when used wisely, but it can also lead to costly mistakes if you're not careful. By building good habits early, paying bills on time, keeping your debt low, and being mindful of your credit score, you can set yourself up for financial success. So, what's the first step you'll take toward mastering credit and debt? Let us know in the comments. And if you found this video helpful, don't forget to like and subscribe so you don't miss out on more tips that can help you manage your financial future. Thanks for tuning in to Factful Finance. We think you'll find the video next on screen interesting, and it might just help you reach your financial goals. Keep making smart choices, and we'll see you next time.